Good morning. Welcome to the Mpac seminar, or presentation, should I say. So what we're going to do this morning is I'll take you through the quick summary of the progress we've made in the first half of 2022. I've got 3 case studies to talk you through, which I think you'll find, or hopefully you'll find, very interesting. And then I'll pass you across to Will to go through the financial numbers, and then you can come back to myself for the outlook for the next 6 months towards the end of this year. So first of all, by way of introduction, today we'll present to you a set of results that were produced in challenging circumstances. The first half of 2022 saw a culmination of a lot of COVID-related disruption coming to fruition. Despite the commitment of all our global employees and numerous mitigations, the financial impact was seen, and we reported that back in July. We have, however, made a lot of progress since then, and including on our strategic agenda. So the medium-term prospects for the group are still very exciting. We are confident that we'll make a full recovery towards the end of this year into next year, 2023. So just a quick reminder of what we do before we get into the financial numbers. We provide automation and packaging machinery used by the FMCG industry to assemble and package their products for onward storage, distribution, and finally consumption by the public. The equipment we supply maximizes package quality, process efficiency, and working sustainably to minimize waste. So here's the slide with the overview for 2022 first half results. I'll just pick out a couple of points there to talk about. The order intake, you can see that that's lower than 2021, the same period. Why was that? Well, if you remember, we were 137% of our order intake for 2021, and that all came in the last couple of months of the year. And customers were there definitely anticipating their orders into 2021, which left a shortfall in the first half of 2022. So nothing really to be concerned about there, and it was mostly around food and beverage as well, we have to say. The revenue. You can see that that's higher than the equivalent period last year, which shows that we're continuing to grow our revenue. And that was a very much a senior management decision to really service our customers during the first half of 2022, and forsaking, to a certain extent, you'll see in the numbers, the margin, which was really a loss of productivity, which led to the margin reduction because of the supply chain disputes. And I'll come back to that shortly afterwards. Some of the other things I pick out in there is the underlying operating profit is clearly lower than it was the year before, but we have implemented a number of mitigations, cost saving programs. So there was an exercise of reducing our costs, which equivalent to about £1 million earlier in the year, and then we took the decision at the half year to reduce our operating costs by £2 million per year on an ongoing basis. So there was some cost savings, headcount reduction in the middle of the year to accommodate that. Just talking about some of the things we did, you'll be very interested, I'm sure, to hear about where we're going with Freya. We spent a lot of time developing that technology this year and delivering on the CQP line, which is the first order that we received from Freya earlier this year. Strategically, we lay some good foundations in healthcare and with the new customer acquisition in that sector, and also in plant-based food, and I've got a case study to talk to you about on that one later. The service product Mpac Cube, we're launching formally a new version of that in Chicago later this year at a trade show. And then the launch of the Mpac Academy, which I think is really important to the future growth of the group. And this is where we're hoping to develop, or we will develop, our own internal talent for leadership positions in the group and expand our graduate recruitment program in the coming years. We also made the appointment of a group procurement director. This was internal appointment. We moved one of our managing directors from the Dutch business in Beacon to the role of group procurement director, and that's obviously helping us to improve our supply chain in the current circumstances, making a big impact in that area. So just moving on then to the next slide. What do we do? It's a reminder really of what we do. We go to market now as Mpac Automation Ecosystems. As you can see on this slide, we changed all the websites very early on this year. So that's our now go-to-market proposition, whole line, whole life for the whole planet. So that means what? Offering our customers full solutions or wider solutions to their needs, looking after the product, the project or the equipment for the whole life. So that's all about getting the maximum productivity out of the equipment, and looking after the planet means helping our customers to eliminate, reduce waste, improve their operating performance, which is the biggest impact we can make on sustainability and and improving our customers' proposition going forward in their sustainability credentials. If you look at the icons at the bottom end of the slide, you can see that where our product groups align to that, the Mpac Lambert product line looks after the first three icons, so assembly, filling and dosing, and primary packaging. That was the business that we acquired, if you remember, about 3 years ago, and that enables us to be at the front or in pole position for customer projects dealing with healthcare, assembly, and packaging. And then if I look at the other 5 icons, product handling and in-feed, cartoning, tray forming, case packing, and palletizing, these can be serviced by either our Langen product line or our newly acquired, 2 years ago acquired Switchback product line. And the difference in those two product lines is specification and price ticket. The Langen product line is very sophisticated with a lot of controls, process, verification, inspection cycles within the equipment, generally looking after higher speed, flexible products. And Switchback was the company we acquired 2 years ago, which offers a solution at a less technically high level and obviously a lower price point. So that's now how we go to market. Mpac Cube covers all those product lines, so we can now offer an agnostic to the control. What does that mean? Whatever control our customer specifies, even if they want different control systems on the different product lines, we can offer an Mpac Cube solution to really utilize the digital technologies that are embedded in our product lines. I'll come on to that more in the case study later. Next slide. In terms of global reach, not a lot of change on this slide since last time. All I'll report here is that our USA facility is really now up and running fully. We're in the new location as we reported towards the end of last year. We have brought in new leadership there, a new managing director for the site, to support really the previous management in the development, but we felt we needed a more experienced managing director to come from within the industry to help guide the development of that site to becoming our USA headquarters in the coming years. Next slide, please. What's changed here? We still very much focus on healthcare and food and beverage as our main strategic markets. You can see that the size of those markets is substantial. The column that says solutions is really where we offer market leading solutions in those areas, and our strategy has been to try and expand into adjacent customers that also do something similar, and that's been quite successful over the previous years to allow us to grow and expand organically in that space. If you like, the mega trends or macroeconomic drivers still remain the same. We're thinking now about high inflation in the world, the geopolitical instability, but nevertheless, populations are still growing. Urbanization continues, so therefore food needs to be packed, transported, and stored. The same in healthcare. People are living longer, living with conditions. And I think the third thing that we'd add to that is the drive for automation. Over the last 2 years, we've seen labour availability, not only in the UK, but in our other operating areas of Canada, USA, and the Netherlands. Labour availability is becoming more and more of a challenge. So the cost of automation, the return on investment, is getting more and more attractive. And our end-of-line case packers, which if you follow in the Mpac story we launched a couple of years ago, are becoming more and more successful because of the lack of skilled labour in the workforce to be able to do the end-of-line case packing. So I think automation is another strong driver. What we've added here for the first time is the clean energy sector. We've been obviously working on this now for a good time. Actually, if you look back, it's been 4 years, but we've only been talking about it publicly for the last year since we won the CQP line with Freya. But we started to look at that market now as another market sector, an attractive market sector for Mpac over the future. You can see today it's a $7 billion industry, and that's today with a 30% compound average growth rate. We've looked into this with some consultants. We've engaged some consultants to look at Mpac's proposition in this space and what the addressable market is. And with this advanced battery technologies scheduled to grow at 30% compound average to feed electric vehicles and energy storage systems, we believe Mpac has got some really attractive technology in the battery cell automation space that could drive growth over the coming years. And in particularly in Europe and the US, most of the conventional battery cell automation providers are coming out of Asia at the moment. And with all the geopolitical headwinds, there is a real drive to move production into the regions and maybe the countries for long-term energy stability. I was at a conference last week, and the CEO of Siemens suggested his biggest concern is that China move into Taiwan, as we've seen with Russia and Ukraine, and the stability then, well, the impact would be much more substantial. Given that Siemens had a 1.5% footprint in Russia, they have a nearly 20% footprint in China. So you can just imagine the ramifications. So stability in the region of energy supply is becoming a huge topic. Next slide, please. In terms of strategic goals, I mentioned earlier, it's been a challenging first half of the year. We've done a lot to mitigate it, but we've still managed to make good progress on our strategic goals. I'll just pick out a couple of things there. The business development around the clean energy sector. Yes, we had a project with Freya to deliver a CQP line, which is a customer qualification plant line. But we've been, putting a lot of engineering development in that, so we can offer a solution to the wider industry. So that's, really exciting. When I look at the Mpac Cube, this is for me a growth driver for the future and more of a profitability driver because of the ability to offer our customers a comprehensive service solution to their equipment orders, to really be able to generate a lot of data from those lines and use that data in a meaningful way to improve operational efficiencies for the long term. I talked about the Mpac Academy. We had this is the inaugural year for our Mpac Academy. We had an event in Canada last week where we had all the candidates together for a full week and going through leadership development and other training programs to work collectively as a group. And this is aimed at the next level leaders around the group to be able to self-develop so that there's an awful lot more understanding of the group and the strategic goals we have for the group from internal employees, rather than having to continually go outside of the group to bring middle and senior management into the company. When I look ahead to the future, this focus on the clean energy sector, this is really an exciting journey that we've just embarked upon in terms of what the future prospects for that market are, where we need to position ourselves, and the ramp up plan behind of that. That's going to be quite challenging in a very good way for the group over the next couple of years. The switchback product line launch into Europe, we've done an awful lot of preparation in the last 12 months. We're now assembling equipment in Tadcaster in our facility in the UK. And we have a trade show next week, actually, in the Birmingham, the PPMA show in Birmingham, where we'll launch that formally into the UK market, and then later this year into Europe. And then continue with the Mpac Academy. I think it's really important going forward for the right skills and talent within the group. There is a war on talent within our industry sectors, looking for highly skilled engineers and software engineers to continue to develop the business and help us along our growth journey. So looking to bringing in more graduates and putting graduates through company dedicated training programs is the way we see the talent pool improving going forward. Next slide, please. So supply chain, I'm sure a number of you have questions on your mind about supply chain. We're saying that was the main reason why our margin was impacted in the first half of the year. And absolutely it was. And the main thing is productivity. And why do I say productivity? it's not just a question of long lead times, which we can accommodate and work around. It was the unreliability of the suppliers' scheduling. So what that means is that they kept changing the delivery dates. And the reason why we only announced the forecast change in July was because up until the spring and early summer, the dates were fairly consistent, but then we were hit with a slew of rescheduling, especially from on the key electronic components. And this is coming from companies like Rockwell, which is the Allen Bradley control, if you know the specifications of these products, but also Siemens. And their issues come directly one-to-one to the silicon chip supply. And we all probably recall in the early days of COVID, there was this huge drive for everybody to work from home, and you couldn't buy a laptop for love nor money. The chip supply obviously going into consumer electronics, and we've all heard about car supplies. So they're the main markets for silicon chips. So people like Siemens and Rockwell take a lower priority, and you can then decipher that down to where Mpac sits in their food chains. So we've done an awful lot over the last several months now to get very senior discussions going with the MD of Siemens in the UK, but also the vice presidents of Rockwell in the US and in Europe, to ensure that Mpac's deliveries and supplies are understood and progressed. And I can now report that the deliveries are now back on track. There is a lot less rescheduling, and we've recently had some good supplies of key electronic components, which will enable us to accelerate some of the backlog of projects we've got in our facilities, and gives us a lot of confidence towards the year end. The other couple of issues, logistics was an issue earlier in the year, maybe the back end of last year. They seem to have corrected themselves. There's an awful lot of containers stuck off the North American coast coming from China. We don't have such a big footprint in China, but we did order quite a lot of key precise engineered components from there, and they did impact us earlier in the year, late last year, but that now seems to have been resolved. The issue that continues is the geopolitical volatility, as we've described it there, and the high fuel prices leading to high input costs, material costs. But we just put that into a global perspective. They're not seeing the same issues in North America because they're more fuel independent, but we've certainly seen that issue in the UK and Ireland. So there's a certain level of cautiousness still in the forecasting because of these unknowns that we're still having to grapple with. Okay, next slide, please. So in terms of case studies, just a quick review of these three case studies. The Mpac Cube I spoke about earlier. What is this? It's where we bring in all our service products together. So you can see on that slide, core services is what we did anyway. Retrofits, upgrades, service technicians being called out for breakdowns, spare parts, they're all covered by core services. But what we're enhancing that with is a number of digital technologies, advanced engineering, connected services, machine insights training, and we're packaging that up as Mpac Cube. So we can now offer that as an independent high-level software suite that sits above any control. So that could be Siemens, Rockwell, B&R, Lenza, whichever control our customer specifies. And even if we have a fuller solution delivered to the customer with 2 or 3 different controls, we can still put our Mpac Cube, and we really believe that's unique in our industry. And it's something that we've been trialing out on our Langham product line for a year. We now sell around about 1/3 of the new projects have the Industry 4.0 suite of enhanced digital technologies added to them. So that's really exciting for the future. The tray former, this is a new product we're launching this year. We're launching in Chicago in a month's time at the exhibition. And this is being driven by Mondelez to move from plastic trays to a cardboard corrugate tray. And the machine that we're launching there is able to do this at 200 per minute, which is really a very, very fast. And that's the sort of speeds they need to make it economically viable to replace the plastic form tray. So this is where we're working in conjunction with our customers for their sustainability goals. And then clean energy, we have a slide on Freya. But I just wanted to emphasize how much R&D has gone into that project this year, which has also been a headwind on our profitability for the first half of the year. Next slide, please. Tattooed Chef. Now, this is an interesting customer. This is where we've gone into the plant-based food market. Not per se that was the end customer's product. This is a very unique company. It's a company that started as a sort of buy and build project. It's quoted on the Nasdaq US stock exchange. And the company is basically buying up production facility and then putting their recipes into those companies. But the overarching strategy is to have the very latest equipment to future-proof their investments. And they did quite a careful selection process to look for the manufacturer who could offer them full solutions for their food packaging. And they selected Mpac. They're based in California. In LA, and I went over to see them a couple of months ago, and it was the Mpac proposition that really resonated with their plant-based food and their the younger generation that they're selling their products to. So a very exciting step for us, and confirmation that Mpac is really resonating with this type of company globally. Next slide, please. Yeah, Freya. Where are we with Freya? When we reported the numbers last week to the investment community, we were still at the stage there where we were delivering on the CQP line, which is, just to explain what the CQP line is, customer qualification plan, and that's for Freya to have a show and tell equipment so that they can do limited volumes of battery product that they can then put to the customer for qualification process. So that line will be their R&D development facility. But they've now got the investment needed and the contracts needed to launch their Giga Arctic, which is on the slide here. And last Thursday, we signed an agreement in Norway with Freya to be the supplier of the battery cell automation lines for their Giga Arctic factory in Mo i Rana. And I think that's a fantastic milestone for Mpac. Why? Well, it puts us in a position where we will be supplying minimum 4 lines, but it puts us in pole position for the development going forward. There are very few, count on one hand, less than one hand, companies who've got the capability to produce these lines. So being in the pole position, having a supply agreement for the first 4 really is a great step forward for Mpac to be a leading player in this market for the future. Okay, sustainability. As I said earlier, our best proposition is to work with our customers to help them improve their efficiency and reduce their waste. So we're working hard with our customers. The Mpac Cube product is helping us along that journey to improve our customers' efficiencies, which is one-to-one, helping them to become more sustainable. We per se don't have a large carbon footprint. It's downstream where our customers are using an awful lot of materials and products, and we can help them reduce the amount of products, the amount of material, and produce what they need to produce in a much more sustainable way. So with that not so quick introduction, I'll pass you across to Will to go through the financial numbers. Will?
Okay, thank you. So starting with the financial highlights for the first half of 22, the highlights reflect that challenging first half of the year. Well, if I start with order intake, Tony's already said we had a really strong back end of 2021 with customers bringing forward a significant value of orders which we had anticipated for the first half of 22. Main motivation there was to secure lead times from Mpac. So that's had an impact on the quantum of orders that we received in the first half. It's 32.8 million compared to first half of last year, which was 51.8 million. In terms of per category, how we break that down, so actually service order intake was up compared to the first half of last year. OE order intake was about 40% below, reflecting that acceleration of order placement dates. And regionally, where was the split of order intake? With the Americas or customers in the Americas region was where most of the accelerated order intake took place. So the Americas was down slightly compared to the prior year. Order intake in EMEA and APAC were both up compared to the prior year. If we look at revenue, so we're reporting revenue at 50.6 million, it's up 14%. And this is where it demonstrates we've worked hard to keep our commitments to customers' lead times despite these operational challenges driven by supply chain disruption. So yeah, we've got this anomaly where we've got a difficult environment operationally, but we've still been able to keep projects moving forward, which reflects the increase in revenue over the prior year. In terms of a split again by sector or service, you can see on the slide on the top right hand side, service and OE revenues up significantly on the prior year, but service continues to show a nice positive trend. In the first half of this year, spare parts have been the main driver to that increase in service revenue. And with OE, we've seen an increase, as I say, mainly in EMEA and APAC. And that combination of order intake, 32.8 million, and revenue of 50.6 million is generating a closing order book of 62.6 million. So it gives us quite a healthy coverage of revenue that we're forecasting for the next 6 to 9 months. We move on to talk about margins. Well, we said margin has been the biggest, has been impacted most by the operational challenges, but there was also other factors that have contributed to the lower margin in the first half. So we've invested heavily in new product development. A big slice of that is associated with the development of the clean energy CQP line. And clearly that's had a positive impact and put us in a good position with a customer in that sector, which was the basis for the announcement last week. But there's also been a price increase from our suppliers, which has had an impact as well. And that's reflected in the chart on the sort of bottom left-hand side, where gross profit margin percentage has decreased to 21.1% against a long-term trend of around 30%. So the quantum's there, the impact, as I say, supply chain disruption was a major part, but there's also an impact from price increases and our own investment, which we've taken the decision not to capitalise. We've invested in and accepting that as a cost in the year to put us in this good position with that sector. So that margin impact has resulted in operating profit of 1.2 million compared to 4.8 in the equivalent prior year. If we move on to talk about cash outflows and cash position, the cash outflow on operation level for the first half of 3.3 million. Main driver there is the increase in working capital of 5.1 million, and there's some more detail on the following 2 or 3 slides which talk about working capital and breaking that down. And closing cash at the end of June, 9.5 million. So you can see compared to the prior half year of 11.2 and the prior full year, December 21, of 14.5 million. So still a healthy cash balance we're reporting at the end of June. And then some statutory numbers, statutory loss before tax of 0.4 million and an underlying earnings per share of 3.6 pence. Move on to the next slide, please, Hannah. So this gives a little bit more detail on the group income statement for the first half of the year. We've touched on some of this. You can see the growth in revenue split between OE and service on the right-hand side. Talking about revenue by region in a little bit more detail now. So the Americas was broadly unchanged. The growth in revenue is mainly supported by EMEA, which is up 45% on the prior half year, which reflects their strong order book. And APAC, which is up 50%, but it's a smaller base number because we don't have such a significant play in the APAC region. But pleasing to see the EMEA and APAC growth, which helps balance our position across the Americas and balance our position regionally. You can see SG&A costs included on the chart there. SG&A costs are about £500,000 lower than the prior year. Tony mentioned the fact we've taken some decisions to either defer some costs or reduce our overheads in the first half as we identify the impact on margin from the supply chain disruption. So whilst that's primarily going to result in lower cost base going forward, there was still some impact on the first half of the year. So SG&A costs are about 0.5% lower than the previous year, and an underlying operating margin of 2.4%. Non-underlying items for Mpac, we have a relatively significant amount of our cost base as non-underlying items. That's a mixture of amortization of intangibles and some pension administration charges, and a underlying tax charge of 0.4 million. Mainly that's tax charge rather than a cash tax position, and that reflects the profitability per region and our ability to use tax shields in those regions. If we go to the next slide, please, Hannah. So the balance sheet, where we stand here. Well, the biggest item that's moved on the balance sheet is the UK pension asset. So that's increased by 24 million. The driver to that increase is primarily an increase in the discount rates, which have gone up by about 1.9%. So whilst an accounting surplus obviously doesn't mean a huge amount in terms of the company's access to that asset, what it does reflect is a trend across the pension landscape where funding levels have improved significantly, mainly driven by increase in discount rates. And so it's a positive trend. The most important factor is how it impacts our valuation on an actuarial basis, and we're still in progress of concluding on the previous valuation until June 21 with the trustees, but it should be seen as being indicative that schemes are moving in the right direction. In terms of working capital, I guess that's where there's the most interest. So looking at inventory levels, we have increased inventory, and it's been a trend over the last 12-18 months to help shield the impact of lead times. But the real main drivers are within trade and other receivables and trade and other payables. And whilst on the headline number, trade receivables and other receivables haven't changed significantly, there's been quite a significant change within that position. So put the comments there, as you can see, contract assets are up significantly. It's 19.2 million compared to the year-end position of 12.7 million. So this reflects the increased value of projects that we've got on our assembly floor or that we're working on, that are where the completion is being held up by parts not arriving on time. So we've continued to work across a wider range of projects. Those projects haven't been able to be completed to the extent of hitting billing milestones, so we're building up a contract asset. At the same time, other trade debtors has reduced. So this reflects, again, the fact that less projects have moved from the position within contract assets to trade debtors. We're building up a larger value within contract assets. Trade debtors are being unwound naturally as customers pay. And on the other side of the equation, within trade and other payables, we've got a significant reduction in the value of customer deposits. So again, this reflects the timing of order placement. I said earlier, orders were placed earlier towards the back end of last year, but earlier than we anticipated. That brought deposits with those orders into 2021. Order intake is lower this year, and that reflects the reduction in customer deposits. So they're the more significant moving dynamics within our working capital position. There's a working capital bridge on the next slide, which will give a little bit more, provide a little bit more context of that. And then we've got the last comment, the deferred consideration in respect to Switchback is included within current liabilities. If we could move on to the next slide, please, Hannah. So with the working capital bridge, probably interesting to see how it flows on the right-hand side there. We've spoken about the profitability of the business. EBITDA is 2.3 million, but the big transition from the year-end to the half-year position is the movement in working capital. So as always, it's a snapshot in time at the end of June, where we've reported a 5.1 million increase in working capital. The other positions within the cash bridge are commitment to the pension scheme, the ongoing deficit recovery payments, so 1.1 million in the first half of the year. CapEx is relatively light. Those who know Mpac, we're relatively capital light by nature. We have now come off the back of a 2 or 3 year period where we've been investing in business systems, moving all of our businesses to common engineering platforms, common ERP platforms. And that investment cycle is broadly concluded by the end of last year. So we're now in a position where the amount of CapEx that we're spending for the outlook for the next 2 or 3 years will be significantly less, and we'll be focusing more on leveraging that prior investment in that one Mpac business model, one Mpac business systems. So that's the bridge through to the half year closing cash position of 9.5 million. On the left hand side, you can see some of those movements that I spoke about earlier. The reduction in trade debtors, the increase in contract assets, and the reduction in customer deposits being the 3 major movements which reflect that transition from 14.5 to 9.5 million of cash. Other interesting comments for the first half. Well, it was just after the first half actually, but we concluded on rolling forward our recovery, our RCF position with HSBC. We had a committed facility with them of 10 million that expired at the end of June, and in July we have entered into a 3-year agreement for an increased facility of 20 million. That takes us through to July 2025. And despite the spike in working capital, which is related to a point in time position, our balance sheet remains strong, and that strong balance sheet alongside that 20 million facility which is committed gives us sufficient capital to be able to invest in the business and to meet our longer term strategic growth drivers. So with that, I'll pass back over to Tony.
Yeah, thanks, Will. Yeah, just a quick summary then. And where are we? We've got a good order book, as Will's just explained there. We've got a really good prospects pipeline, which I think I've talked about in the past. We focus on our CRM system and the prospects that we've got for the next 12, 18 months in advance to give us confidence about where we're going. So good order book, good prospects. We've got a good balance sheet, as Will's just explained there. Yes, it's been a challenging first half of the year, but I think we're working through that. Really tremendous effort from all our employees stepping up and being flexible and agile to sort of work around these things. We're making good progress on our strategic journey. I think the step into the clean energy sector, we've spent a lot of time and energy on R&D with the product, developing this CQP line. We're scheduled to deliver that by the end of the year, and we're now working on a plan to really broaden our exposure to that phenomenally fast-growing market, which I think is going to be great for the future. So I'm really pleased by the progress we've made strategically in the last 12 months, and the company is in really good shape for the long-term or sort of medium-term prospects in healthcare, food and beverage. So saying all of that, we really believe that we're in, the board believe that we're in a great position to continue our growth story despite a bump in the road for the first 6 months of 2022. So with that, I'll hand you back to Hannah to go through our Q&A session.
Thanks to both of you for that presentation. We've got a number of questions. Could you give the reason why for the increased borrowing facility? Was there a project in mind for this?
Well,
well, two aspects. So that first part, the group has ambitious growth profile strategy that we want to deliver upon, and we think there's a fantastic market in front of us, and we want to grow the group over that to 2025, and we've got plans to deliver 10% compound average growth rate. But alongside that, Mpac is a capital goods business, and we do have movements in working capital that can be up to 10% of our annual revenue. So we needed to have in place the facility to flex. We haven't used the facility previously that we had in place, but we wanted to ensure that we had sufficient access to capital to be able to meet that growth agenda that we're on. Alongside that, we clearly knew we had a great opportunity coming in our direction from the customer in the clean energy sector, and yeah, we needed to have the capital at our disposal to be able to access that. So primarily, it's about ensuring there's sufficient finance and capital to be able to meet our working capital requirements. But clearly, there's a new topic on the agenda with Freya.
Thank you. The ongoing low gross margins suggest that the current business is largely a commodity business competing on price. Can we expect much higher margins on the new technology-led business such as Freya?
Just a quick comment from me on that. Low gross margin. Yeah, we can take a view on that. I think the margin has been impacted in the first half of 2022 because of the reasons we explained. We're on target to build our margins up to the mid-30% going forward, and we expect the Freya contract to be in line with that going forward. So, we do compare ourselves in the industry. Most of the companies in the industry are not public companies, so we have to delve into the private accounts. And our gross margin previous to the first half of the year and our aspirations going forward are pretty strong. Anything you want to add, Will?
No, we've been on track to deliver that long-term objective, a 10% return on sales, and that was seen as quite aspirational at first when we started that journey. We were on track. This year we've been impacted by the supply chain constraints and supply chain disruption, but I think we're supported by this opportunity in the clean energy sector. We'll be back on track to hopefully reach that threshold again in the near future.
Do you currently expect contracts coming from the Freya framework agreement to include upfront payments, or will they absorb working capital? And if it is the latter, are your current borrowing facilities sufficient?
Will?
Yes, the borrowing facilities are sufficient. We expect most of our contracts that we have with customers for there to be an upfront payment. That's typical with most of the contracts we sign. So, yeah, the short answer is yes. We expect an upfront payment. We have sufficient borrowing facilities, and we're very confident we can meet the capital requirements to be able to deliver these lines.
Does that leave you with capacity to make incremental acquisitions?
Well, acquisitions is always on our radar, and yes, we have got ambitions, desires to acquire further companies to build out our proposition for our customers. So we don't feel as though we've got any funding constraints around our acquisition strategy and our ramp up for the Freya development, or for clean energy development, let's say.
We have a detailed question here around the size of the Freya contract. I'm sure your answer is going to be what is in the RNS, but broadly it says, I understand Giga Arctic covers over 5 times the area, has 8 times the number of production lines, and has nearly 80 times the annual capacity of the customer qualification plant. Would it be a fair assumption that the size of the contracts for casting and unit cell assembly will total well in excess of 8 times that for the customer qualification plant?
But yeah, it's difficult to speculate at the moment. But as I said, our contract is for the first 4 lines for the Gigafactory. They're doing it in stages. Leo Investor UK is correct that there are 8 lines per Gigafactory. So we have to, work within what we know. So we've got a supply agreement for the first 4 lines. We don't have POs for those yet. So the speculation about what the value could result in, the best we can do at the moment is 4 times the current value of the CQP line, which I think we've talked about before, of circular 10 million value.
Thank you. Pension. The outcome of the negotiations over the triennial valuation were reported in June 2018. For the June 2018 one was reported in June 2019. How are the 2021 negotiations progressing?
Yeah, they're progressing really well. We're very close to concluding on the 2021 valuation. The timetable should result in it being concluded by the end of September. I suspect it's going to go past that date, but not past that date because there's a problem or an issue with concluding on the valuation. It's more associated with the fact, as I mentioned earlier, that pension schemes overall funding levels have improved and increased because of increases in discount rates. So with that in mind, the company has sought, and I think we're almost there, being able to tie in some arrangements on what we do if we reach the point of being fully funded or above between now and the next valuation. So we wanted to ensure there was some protection to the company in that period. That's been wrapped up within the June 21 valuation. And that's why it's taking a little bit longer to tie up, but it's not that it's a concern. It's just process that we're going through. If we conclude it by the end of September, great. If we don't, it will be shortly after, certainly by the end of the year. But funding levels for schemes across the board have improved, and the scheme that Mpac is funding is no different. So regardless of the outcome of the June 21 in terms of the actual valuation position, yeah, our scheme, like all schemes, are moving in a very positive trajectory.
Thank you. Back to the clean energy market. Are there any other battery opportunities similar to Freya already in discussion?
Just a bit more context around the slide we showed earlier. Our opportunities with the advanced technology batteries, which is semi-solid and solid state. There are an awful lot of suppliers of the conventional, what you see today as the battery technology. But as we all know, that they've got constraints in terms of longevity, in mileage, in terms of also in cost and waste. So where we're trying to position ourselves is in this advanced battery space. And the short answer is yes, we're working with at least 2 other developers of new phase battery technology. And that's why we're broadening our appeal in that marketplace, because we can see that there are, somebody else is asking here about competitive advantages, disadvantages. At this stage, there are very few players in that market, and we have got technology which has yet to be proven. We're still making the CQP line, but we're very confident that that will leverage out, and that will put Mpac in a really strong position going forward for these advanced battery technologies.
Thank you. Do you have an update on the land at Hemel?
Yeah, just a short update. We put a very big fence around it to stop encroachment on the land. It's a fabulous piece of land, and I'm sure at some point in the future, the local council will agree with us that it isn't green belt. It's a brown belt because it's been built on previously, and there will be at some point some development on that land. But we're not proactively pursuing that. We're not spending money. We spent quite a bit of money on pushing that to the High Courts last time in terms of a planning application. So it sits there, and I am sure in the fullness of time it will get developed.
Will, have you allowed for the increase in interest rates coming down the line, and what impact this will have on projected profitability if future projects go ahead?
Yes, on forecast projects, yeah, for increase in interest rates. Well, at the moment, we remain in a cash positive position. We've invested a little bit more in projects since the half year, but the group is still not exposed to increases in interest rates. But as we get into the position to look at what it means to deliver on these first lines for Freya, that may change, and we will absolutely factor that into the cost of delivering those lines. So it's Freya aside, that's not a topic for us, but we will absolutely factor it into the cost in for Freya.
Well, thank you to you both, and that looks to be the end of the questions. So we look forward to a further update in 6 months' time.
Thanks, everybody, and thanks, Hannah, for hosting today's session.
Yeah, thank you, Hannah.